There's been a lot of confusion over the new dividend tax rates that will come in from April 2016. In my opinion, there really shouldn't be. It's a fairly straightforward change, but we do need to make sure we understand what those changes are and also what the consequences are. First of all, we should look at how the rules are changing, Tim. The old rule had this very strange credit system where, although you were given £90, you had to pretend it was £100 to then pay tax at 10%, but then they covered the 10%, which took you back to 90. It was effectively naught. And then we had this higher rate, which was 25, but it was really 32.5, which was the same sort of situation. That credit goes completely from April 16. That's the first thing to note, isn't it?
It is. I must resist the temptation to go fully into the history, but before Gordon Brown changed it, there was the old imputation system, and companies paid advance corporation tax and advance payment on their eventual liability whenever they paid dividends, and that for some reason became an imputed tax credit. But under that system, the effect for a basic rate taxpayer at 20% was that the credit covered that, and for a higher rate taxpayer it meant they had a quarter of the net dividend to pay. And when Gordon Brown changed it, that's why he imposed a 32.5% higher rate on dividend income. If you gross up a dividend of 90 and then tax that at 32.5 and take away the 10% credit that we now have, you're ending up with 22.5, which is a fraction of the 90 as a quarter. Ridiculous complications, but there we are. Now, what Osborne announced in the July budget speech was that all of that's going to go from next April, and instead of the notional 10% credit, there will be no difference between a net and a gross dividend. It'll be like rental income. You don't take net or gross rental income, you just take the profit from the rental business, and that's then taxed. Well, the dividends will be taxed at the appropriate rate. That's the first point.
So the key message was that basic rate taxpayers paid no tax on their dividends, higher rate taxpayers paid 25%, and then we had yet more strange calculations for additional rate taxpayers.
It got a bit common. It's worth mentioning the figure. The additional rate on a net dividend, which is what investors want to know, was an effective rate of 30.6%.
Okay.
Now, I mention that because the second point is that all dividend recipients will enjoy from April 16 a so-called dividend tax allowance of £5,000. The first £5,000 will be tax-free, albeit that's not to say we ignore them, because the 0% rate on the first 5,000 will be an alternative to whatever other rate would apply on that 5,000.
And then we have three rates from then, which relate to either basic, higher or additional.
That gets us to that third point, the three rates.
The old rates plus 7.5.
Exactly, and across the board, 7.5% hike. So in very simple terms, he's giving everybody the potential of 5,000 of dividends tax-free, but then on amounts beyond that, he's hiking the rate by 7.5%. Now that means that if the dividends remain within your basic rate band, instead of 0, it'll be 7.5. If you're a higher rate taxpayer, dividends within your higher rate band beyond the 5,000 tax-free, instead of being taxed at 25, they'll now be taxed at 32.5. And if you're a top rate taxpayer, over 150 grand of total income, then you'll still get your 5,000 tax-free, but beyond that, there will be a 38.1% rate. Some will remember the old investment income surcharge. There used to be an investment income surcharge on all investment income of 15%. That went years ago. In a way, Osborne is going back to a dividend income surcharge of 7.5%.
But worth remembering that the surcharge was on top of whatever other tax you were paying. If you had a salary, it could have been at one, of course, you previously up to 83%, it could have been on a salary, plus the 15% for the dividend to take you to a 98%
That's
tax
right.
charge.
Yeah.
This isn't a surcharge on top of 20s and 40s and 45s. This is a standalone charge. Let's do two examples just to make sure everybody's happy with this. I have a salary of £10,000. I have dividends of £10,000. That's it. Well, my 10,000 salary is covered by the personal allowance. I'll have 1,000 of personal allowance left to use, so that would take the first.
That's next year, 2016-17, we've got a personal allowance of 11,000, so 10 of that goes on your salary.
1 goes on my dividend.
1 goes on your dividend.
Then the next 5 The first 5,000 of taxable dividend is covered at naught, which leaves £4,000 at 7.5%.
Correct.
Example 2.
So 300 quid is what it's going to cost that taxpayer. At the moment, in that scenario, you'd have no tax to pay at all, but it will be a £300 charge next year.
Okay. Compare that to somebody who has a salary, let's be silly about it, a salary of £1 million a year.
Okay.
They're through the personal allowance, through the basic rate, through the higher rate. They're up into the additional rate. And on top of their huge salary, they have £10,000 of dividends.
Okay.
How will that be taxed? £5,000 at 0 and then £5,000 at 38.1%.
And 5,000 at 38.1% will cost them £1,950. Whereas at the moment, the million income individual with 10,000 of dividends would be paying 30.6% on the 10,000, which is 3,060. So actually, they're getting a tax reduction. But that's the way it works, I'm afraid. Of course, typically, the individual with $1 million a year of income is likely to have rather more than 10,000 of dividends, and it will hurt those with very significant dividend income.
And I think that there's 2 good points, though, that people haven't really picked up. There's been a huge amount of focus on this, saying it's unfair because people were paying at naught and now they've got to pay at 7.5%. Of course, if you're taking low salary, high dividend, £40,000 a year in total, you're actually moving from 0 tax up to around about £1,800 of tax. So it's still under 5% tax overall. 2 things to highlight that are good piece of news. One is the £5,000 that is available wherever you start your dividends, and that's as the point we've just made there with the example. The second point to pick up on, if we don't have to gross up the dividend from 90 to 100, then your figure in your tax computation is lower to start with. If you earn a £54,000 dividend this year, that would be a £60,000 dividend in your tax return. Next year, a £54,000 dividend, £54,000. Why have I chosen the number between 50 and 60?
Because of the high income child benefit charge and the way in which, as your income goes between 50 and 60,000, your entitlement to child benefit is gradually removed and at 60,000 gone altogether. And that will have collateral damage effects on a small number of taxpayers who will then find they're not able to get any child benefit, or at least less than they were getting.
But in the future, it means that they will now get more child benefit again because of that fall from 60 to 54.
Because we're not grossing up. The current position is the collateral damage, but if we're not grossing up, then you won't have so much damage.
And then the other place where this is particularly relevant is income between 100 and 122.
Where we have the taper of the personal allowance. £1 for every £2 reduction, half the excess over 100,000 is knocked off your PA. Again, by not grossing up, that'll reduce the effect of that taper.
A lot of people tell me, I read an article the other day that said this ends incorporation. Nonsense, I would say.
Yeah, nonsense.
I would say, all I would say is that it's an increase in tax, but
modest at the moment. However, 2 final thoughts I'd leave you with on this. How easy would it be for a chancellor, even a chancellor who's imposed on himself a triple lock, how easy would it be to increase the 7.5% to 15% or some other figure? Very easy. Second point, tucked away in the releases in the autumn statement was reference to a consultation on the tax avoidance by using distributions from companies. And the Revenue want to have a close look at how companies are using distributions, dividends, to minimise tax bills overall for the proprietors, and they're going to review the transactions in securities legislation, which is not that frequently used, and it may well be that part of that review will consider what you referred to as the low salary, high dividend route. Nothing will happen on that until at the very earliest March, in terms of us finding out more about it, but that is something on the horizon that could be a bit worrying.
So very, very important that we get very good advice on this sort of thing. Make sure that you understand how the rules work, how the old and new rules will work for you. Do the maths, as my niece would put it. But having done that, we also need to think about the accounting consequences as well. A long conversation, I think, is required. But in terms of how the maths works, hopefully Tim and I have helped you, and we look forward to seeing you in the very near future. Bye-bye.